everybody, welcome back to my YouTube channel. Welcome back to my YouTube channel. Oyindifuripelani mashapa, manayana wa muvenda. And if you're here for the first time, welcome. If you're a returning subscriber, a veteran in this channel, welcome back for yet another exciting episode of Risk Money and Insurance. And so today we are here. As you can see, I'm wearing a loose t-shirt, no makeup, nothing. I'm just like chilling. I'm in a relaxation mode. But today I thought we should tackle, one of the macroeconomic factors, if I'm being fancy, one of the macroeconomic factors that affect our lives, whether directly or indirectly. And ever since the pandemic, right, we've seen a drop, in interest rates, and property sellers or like property agents were advising us, it's time to go into the property market because borrowing money is actually really cheap. And so today I am going to literally discuss interest rates, because one way or the other interest rates affect our life. And the reason why I'm doing this video is because there was someone who made a request on, I think it was Instagram, either Instagram or YouTube. I tried to go back and find the name of the person so that I can just give a shout out to them. If you're watching this, you can just say hala, it's me in the comment section. But anyways, they were sort of asking, how does the repo rate changing affect our lives? Because every single day in the news you will just hear the monetary policy has increased the repo rate by 25 basis point, and you're like, what? Prime rate will be this much, right? And so I thought, let's now have a sit down and talk about interest rates, because at the end of the day, if you're going to be transactioning with, holding a transaction with different financial institutions, you need to understand what interest rate is, all those things. But essentially, what is interest, right? Before I blab and all of that. If you haven't subscribed, please hit the subscribe button below. Don't forget to also hit the notification bell so that you get notified whenever I post a new video, which will be on a Thursday evening at 7 p.m. And so when we talk about interest, right? Interest is essentially the cost that you have to pay for borrowing money, right? So if you're borrowing, that is the cost for borrowing money. But if you are investing your money, then interest is essentially the income that you're receiving by the mere fact that you have invested your money or you have saved your money. So it can work for you or it can work against you, depending on which side of the coin you are on, right? And so let's move on now to talk about there are different kinds of interest rates, right? Normally for buyers like you and me, when we are transactioning with banks and all these other institutions, there are different interest rates that are charged, right? The first one is what we call simple interest rate, right? And the second one is compound interest rate. So if you a reader, I once read the book, Atomic Habits and all of that, and they were just talking about how your whole habits compound over time and they make you as a person. So when we talk about compound interest, I know I was diverging there. When we talk about compound interest, we are essentially saying, so I'll give an example in a case of you borrowing, right? Or like you investing. I think you investing would be simpler. So when we talk about compound interest, we are saying that if you put down 1,000 rands, right? And on that 1,000 rands, let's say you are being charged 10% compound interest. What they're essentially saying is that your 1,000 rands will earn interest as the money you have put down initially. That would earn interest. And let's say, for example, over the year you gain 10 rands in interest. So right now, at the end of the year, you're looking at something like 110, for example, right? That's the first year. You're looking at 110 at the end of the year. So you've accumulated that 10%, right? So at the end of the year, moving to the second year now, right? So starting another year altogether, your 100 rand that you started out with, and the 10 rand that you in essence earned in your first year of work will also get interest. So now we are calculating 10% of 110 rather than 10% of just 100 rands, right? So that's compound interest. So your interest also earns interest. Okay, cool. Let's move on to simple interest. With simple interest, it's only your principal amount, so the amount that you put down, so the 100 rand that you deposited into your savings account, that is the only thing that will earn interest, right? So over the years, it's only interest on the 100 rand, that you started out with, not the interest that you will earn on the 100 rand. So going back to our example, first year you also earn, under like simple interest, you also earn what? 10 rands interest, right? Second year, you now have 110, right, essentially in your savings account. But because it's simple interest, we are not going to calculate 10% of 110. We're going to still say, what is 10% of 100 rand, the one that you deposited? So essentially, under simple interest, your interest doesn't earn interest. I hope that's clear. If you have questions, drop them down in the comment section so that we get this whole process out of the way. So it's also very important when you are investing, or when you are not investing, saving or whatever, when you're saving or like when you're borrowing, to understand, is it 10% compound? Is it 10% simple interest? Because it makes a difference. Like in the long run, because your interest is earning interest under compound interest, you make more money rather than when you're putting your money in a simple interest account or whatever the case may be. So it's also important to understand, is it compounded monthly, or it's compounded annually, or it's compounded quarterly? Because the way banks or like other financial institutions honestly present the interest rate, they'll just say 10%, right? But what do you mean 10%? It's very important to understand. Is it 10% simple interest? Is it 10% compounded annually? Is it like 10% compounded monthly? What is that 10%? So it's quite important to understand that, interest language first before you can say, oh, this is the best account. Because someone might say, oh yeah, I'm giving you 10% simple interest, right? And someone might say, oh, I'm giving you 10% compounded annually. Of course, I'll go to the one who's compounding me annually on, rather than the one who's giving me simple interest. So that is essentially the interest rate talk. Now let's move on to the bigger scale of things, right? Yeah. Going to the bigger scale of things in South Africa, we have the South African Reserve Bank. And within the South African Reserve Bank, we have what we call the Monetary Committee, right? These are the guys who have meetings, I think it's every 2 months or every 3 months, where they sit down and they discuss the direction of interest rates in South Africa. So I think what we need to understand is that there is interest rate, essentially, there's a banking system between the South African Reserve Bank and all the commercial banks that we have in South Africa. So we don't deal directly with the Reserve Bank, we deal with commercial banks. So you wouldn't go to the Reserve Bank and say, I want a loan, right? But you would go to your Standard Bank, ABSA, you go to your FNBs and your net banks and say, I need a loan, right? And then they will charge you interest on, what interest is this, what. Okay, cool. So there is a banking system, essentially, that happens, or like banking transactions that happen between the South African Reserve Bank, which is like the lender of last resort in South Africa, the big bank in South Africa, and commercial banks, so the big 4 banks in the country and all the other banks essentially. So the South African Reserve Bank also borrows money to this individual banks that you see, right? They also like transact with these banks. And so the rate that they quote those banks is what we call the repo rate, right? So when they announce that repo rate to say, oh, we're increasing it by 25 basis point or whatever, that rate affects how the big banks, the commercial banks, essentially transact with our Reserve Bank, the big bank in the country, essentially. The big bank in the country. So that's how the repo rate then affects those transactions. But because now, imagine a situation where a bank is borrowing money from the big bank at a higher rate, then that alternatively means it has to affect you as a consumer, because you deal with this bank, right? Let's say Bank X, because we don't want to make this about a certain bank. You deal with Bank X as a customer. Bank X now is, instead of borrowing money at 5%, they're now borrowing money at 6%, for example, right? So if that's the case, then they'll also now charge you more interest, because they're getting money at a higher price compared to what they were getting the money for before, right? So as we've mentioned, the repo rate, right, between the bank and the central bank, Bank X and Central Bank of South Africa, then there is now what we call the prime rate, right? So the prime rate is indeed linked to your repo rate, right, in a sense. And the prime rate is sort of the reference point, that these banks will essentially quote interest to consumers in the country, right? So depending on the kind of interest rate that you have, they can quote you in two different ways. It can be a fixed interest rate. So regardless of what happens to the repo rate, your interest, if they say it's 10%, we're charging you 10% on your mortgage, right? Compound interest, 10% on your mortgage, for example, right? Regardless of what happens to the agreement between Bank X and the Reserve Bank, your interest rate remains the same, right? So essentially what we're trying to say here is, if it's fixed, is that it doesn't change. So it's 10% throughout the term of your loan, unless if you get into loan agreements and you refinance your loan or do whatever, then maybe it can change in that instance. But if you're just going to keep that loan as it is, then it's 10%, it's fixed. Like, we don't say, oh no, the Reserve Bank has increased the repo rate, the prime rate has increased, therefore your loan has to increase. No, it's fixed. It has no relationship, essentially. It's not related to the repo rate. And then on the other side, you have floating interest rate, right? So what that means is what they will normally quote you, right? For people with young professionals account, they know this very well. If you're buying property, they might give you like prime minus 1%, for example. If you are buying, prime is around 8 point something right now, if I'm not mistaken. So it's going to be like around 7 minus 1% is around 7 point something percent, right? So if you are getting a mortgage, for example, with a bank, sometimes they might say, well, we're charging you prime minus 0 point something percent, those things, right? So if the prime rate increases, then the interest that you're essentially being charged on that line of credit has to increase, because your interest rate is dependent on on the prime rate. So in essence, if you are under a floating interest rate agreement, you are accepting the risk that the prime rate can change. And so if the prime rate changes, then what that means is that your installment and the size of your debt, essentially the whole thing, has to increase, right? And so at the same time, you are also banking on the fact that if the prime rate decreases, then your installment and whatever interest they were going to charge you in total will be lower, right? Because you are now being charged at a lower interest rate. So this is what happened during the pandemic. During the pandemic, we were under shutdown, national lockdown, and all those things were happening in our country. And so if you are someone who studied economics, you would understand that consumers not spending money is bad for the economy. The government has to encourage people to spend money to keep the economy going, right? For us to actually increase our GDP and stuff, produce more stuff, because what's the point of producing if you're not going to have consumers? But then the problem with the pandemic was that we were under lockdown, right? So the government then said, we're going to give everyone 350. Why do you think they were giving you money? Well, okay, on the bigger scale of things, they want to take care of the people who are not working and all of that. But also from an economic point of view, the government has to give people money so that they have money to spend to keep the economy going. Because if people don't have money to spend, then who's going to buy all those products that are being produced? And then at the end of the day, how will they make money if nothing is happening, if people are not transacting? So if we all go on a strike, like literally national strike, and we're like, we are all not going to spend our money, we can kill the economy, right? But of course, that's not going to happen, because we need to live and we have all these expenses and things that help to sustain us as people. But at the end of the day, the government needed people to spend money. So then if you want people to spend money, right, they can spend money that they have, which at that point, most of us didn't have money. Number two, they can spend money that they don't have. So in essence, borrowing. So a good way to actually encourage people to spend money is to actually make borrowing cheaper. So the repo rate, right, the interest rate that the Reserve Bank charges the commercial banks, essentially like decreased to the lowest point in history, right, of South Africa. to like a 3.5%. That was the lowest in the history of South Africa. Like, go back, it was the lowest, right? To actually encourage people to do what? To start spending, because if the repo rate decreases, then the prime rate also, because it's linked to it, decreases as well. And then at the end of the day, as a consumer, you get a favorable rate when you now want to, or buy property, or when you want to borrow from the bank. So essentially that's what happens, and I think what people didn't tell us then was the fact that because it's at its lowest point in history, it's not gonna stay that low. It's gonna have to increase and go back to normal at some point. I mean, the prime rate, before the pandemic was somewhere around 10%, right? I feel like 10%, 11%. Okay, there were some periods in the past where it shot up close to 20%, right? So people were like having it then, but like normally it will be around 9%, 10%. That's sort of the normal range, for South Africa. In the past few years, that has been the normal range for the prime rate, actually. So now that we are out of the pandemic, not really out of the pandemic, but like you can tell now we don't wear masks anymore, and like all those restrictions are no longer there. The economy has opened up, people are now back to work, and things are happening again and stuff. So now that things are back, what essentially the monetary policy committee has to do is to guard against interest rates being too low, because if interest rates are too low, then we will have a problem, and a problem that we will face in the future is inflation, right? Because now you have people having a lot of money to actually buy all those things, so demand is increasing, and then price will have to increase, and overall the general prices in South Africa will now increase, and then in the future we're screaming and shouting about inflation, right, as we're screaming and shouting right now. So to curb that effect, we now essentially have to strike a balance, go to a place where interest rates are going up again, to curb the fact that people have too much money. In essence, I mean, it's relative, to curb the fact that people have too much money. So we're trying to play that dynamic to balance things out in the economy, because if the interest rates are low for a longer period of time, we will have an inflation problem in the future, and honestly we don't want to be like Zim, right? So to stop that from happening, interest rates essentially have to go up. And unfortunately, if you have a floating interest rate agreement on your loan, car loan, or like car financing, vehicle financing, or like your mortgage or whatever, unfortunately your installments will now have to increase as a result. But on the bright side, for people who had mortgages before the pandemic, and when the interest rates dropped, essentially their installments dropped. For those people, if they were smart enough, they could have paid off their debts in that period where interest rates were low. So they could have, like, there was a chance for people to either get into debt or like come out in that period. But now we're in a space where interest rates are increasing, unfortunately. So when you get into an agreement now with a credit provider of whatever sort, you will be charged, at least they will be looking at 10%, 11% as like, that's where the normal range will be along those lines in those instances. So I hope this video helped to sort of clarify things and like sort of give you guys an overview of how interest rates are set in South Africa and why they do whatever they do. But if you want, more juice, more detail, leave a question in the comment section. I always read the comments and I always try to respond to all of them. Don't forget to like, comment, share, and subscribe. I love you guys so much. Mwah. I will see you guys in the next video. Oh, bye.